An out-of-pocket maximum is a yearly limit on what you pay for covered care under a health plan. For example, after you reach it, the plan may pay covered in-network costs differently for the rest of the year. The reason is that the limit protects against unlimited cost sharing. That can mean it does not make every medical expense disappear. It usually includes deductibles, copays, and coinsurance. In real life, money paid for covered services can count toward the limit. The pressure comes from this. Premiums usually do not count. The result can be monthly insurance payments are separate from the out-of-pocket maximum. The limit resets each plan year. Think of a person who reaches the maximum in November may start over in January. The process works because timing can affect medical planning. Over time, large treatments near year-end should be discussed with the insurer and provider. Only covered care usually counts. A simple case is this. A service denied as not covered may not reduce the maximum. The important driver is that the plan rules still decide eligibility. That is why the maximum is not protection for services outside the contract. Network status matters. You might see it when out-of-network care may have a different limit or no meaningful protection. What matters underneath is that a hospital, doctor, lab, and anesthesiologist may have separate network status. If it is ignored, checking network details can prevent expensive surprises. The deductible is not the same thing. One ordinary version is the deductible is the amount before certain coverage starts, while the maximum is the ceiling on yearly cost sharing. The mechanism is that a person may pass the deductible long before reaching the maximum. The practical effect is both numbers should be compared. Coinsurance can push people toward the maximum. Consider a percentage of a hospital bill can add up quickly. The hidden part is that the larger the allowed amount, the faster the patient share grows. The outcome is often that major care is where the maximum becomes important. Family plans can have individual and family limits. The pattern shows up when one member may hit an individual cap while the whole family has another cap. The moving force is that the structure affects bills for households with multiple patients. The risk is that families should read the plan summary carefully. Prescription costs may count differently. In a daily situation, some drugs count toward the medical maximum, while others have separate rules. The link is that specialty medications can be expensive. Once that link matters, pharmacy benefits deserve their own review. Preventive care may not require cost sharing. The clearest example is some covered preventive services can be paid without copay or deductible. The explanation starts with coding and network rules still matter. The consequence is a screening can become diagnostic depending on what happens during the visit. The explanation of benefits tracks progress. For example, it shows what was billed, allowed, paid, and applied to deductible or maximum. The reason is that patients should compare it with provider bills. That can mean errors can happen when claims are processed. A low maximum can justify a higher premium. In real life, people with expected surgeries, chronic care, or expensive medications may value cost protection. The pressure comes from this. The cheapest monthly plan may be risky in a high-use year. The result can be plan choice should include worst-case math. A high maximum means more exposure. Think of healthy people may accept it to lower premiums. The process works because the risk appears if an accident or diagnosis happens. Over time, insurance planning should consider surprises, not only normal years. Billing delays can confuse the total. A simple case is this: care received in 1 month may be processed later. The important driver is that payments and claims may not appear instantly. That is why patients should keep records when approaching the limit. Not every charge is an allowed amount. You might see it when providers may bill more than the insurer recognizes. What matters underneath is that the allowed amount decides cost sharing for covered in-network care. If it is ignored, balance billing rules depend on situation and law. Emergency care has special rules but still needs review. One ordinary version is the plan may treat emergencies differently, yet follow-up care can create new network questions. The mechanism is that one event can produce several bills. The practical effect is patients should ask how each claim was processed. Appeals matter when a claim does not count. Consider if a service was wrongly denied, correcting it may change out-of-pocket totals. The hidden part is that the maximum depends on accurate claim handling. The outcome is often that keeping documents helps when disputing a bill. The maximum is best understood as a financial guardrail. The pattern shows up when it limits covered cost sharing but does not replace premiums, excluded services, or network rules. The moving force is that the guardrail works only inside the plana euros terms. The risk is that people should know where the boundary is. Before choosing a plan, compare premium, deductible, coinsurance, and out-of-pocket maximum together. In a daily situation, one number alone can mislead. The link is that a plan with a lower premium may expose you to higher costs if something serious happens. Once that link matters, the topic is understood through before choosing a plan, compare premium, deductible, coinsurance, and out-of-pocket maximum together in practical terms. Out-of-pocket maximum becomes clearer when it is tested in ordinary life. Take patient paying deductible. The point is visible in a patient reaching the annual limit. The choice changes because out-of-pocket maximums changes the pressure around the decision. What matters is the real consequence for the people involved, not just the clean definition of out-of-pocket maximums. When the example is concrete, out-of-pocket maximum stops sounding abstract and starts looking like something people deal with in real conversations, bills, deadlines, and relationships. Another useful angle is coinsurance adding up after surgery. An out-of-network bill that does not count shows how one background condition can change the outcome before anyone calls it a big event. For out-of-pocket maximums, the hidden force is the boundary around covered in-network cost sharing. Once that boundary is clear, the maximum stops sounding like a promise that every medical bill will vanish. An out-of-pocket maximum matters because it can turn an unpredictable medical year into a cost with a defined upper limit. A shallow reading ignores what does not count, such as certain premiums or out-of-network charges. In the case of copays counted differently by plan, the final result may look simple from the outside, but the pressure was already building before anyone noticed it. Better judgment starts by asking which costs apply to the maximum and which sit outside it. A practical example is covered care after maximum reached. The practical point is not to memorize a slogan about out-of-pocket maximums. The practical point is to know the ceiling before a major procedure turns into financial confusion. That contrast explains why the maximum helps most when the care qualifies under the plan rules. Most confusion around out-of-pocket maximum comes from missing that hidden exchange and focusing only on the surface event. The out-of-pocket maximum is a ceiling for covered in-network cost sharing, not a promise that every medical expense disappears. A final example, out-of-network bill not counting, shows why this matters before the outcome becomes expensive, stressful, or emotionally charged. The strongest takeaway is to check what counts toward the ceiling before a big bill appears. The practical point is to know the ceiling before a major procedure turns into financial confusion. Once those parts are visible, out-of-pocket maximum becomes less mysterious and much easier to handle in daily life.